Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hello, and welcome to another episode of the Investor Financing Podcast. I'm your host, Beau Eckstein. Today, we're going to talk about the differences between bank, credit union, Fannie, Freddie, and bridge loans for multifamily properties. So let's get started. As you can see on the screen, there's little brackets. So first, we're going to get started with type of loan. And we're going to go, is it non-recourse? And for bank and credit union, typically it is a recourse loan, meaning you're going to sign a personal guarantee. Fannie and Freddie are both non-recourse. And then when we go for a bridge loan, it depends on the lender. Oftentimes they're non-recourse, but depending on the lender, they do have recourse type bridge loans. So let's go to the next bucket here. Typical loan terms. Bank, credit union, you're going to be anywhere from it should be a 3 to a 10-year fixed. Some credit unions will do a 5-5-5, which is fixed for 5 years, and it has a window to adjust on year 6 and year 10. But most of the time, bank debt's usually a 5-year fixed. And then if you look at interest only, credit unions typically don't offer interest only. Banks sometimes do. It's not as common as Fannie or Freddie. And the difference on bank versus agency debt is, if you look at the amortization, banks and credit unions are usually 20 to 25 years. Sometimes some of them are 30, but more often than not, 20 to 25 year term. Fannie 30, Freddie 30. And bridge loans are usually anywhere from 12 to 36 month term, because bridge loans, the purpose of a bridge loan is to get in and stabilize the property and then refinance or sell the property. That's really the purpose of a bridge loan for an unstabilized property.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
And if we talk about max loan to value on purchase, you're looking at 80% with bank and credit union, and on cash out refinances, usually around 75%. Fannie, 80% on purchase, 75% on refinance. And it also depends with Fannie and Freddie. If it's in a secondary or tertiary market, they might not be able to do 80%. You might be offered 75% in certain markets. Bridge loans, you can go as high as 85% of costs on a purchase. And usually on a refinance, you're about 80% loan to cost. Property occupancy. So what we're talking about here is, what's the occupancy level, right? Are you at 70? Are you at 80? Are you at 90? Bank and credit union is flexible, whereas Fannie and Freddie want a 90% occupancy level for the past 90 days typically. Bridge loans, they're built for unstabilized properties, so they're used to seeing stuff that's not stabilized, and they're more flexible on the debt service coverage requirements. And as far as rehab budget, some banks and credit unions allow you to finance your CapEx. It's kind of like a 50-50. In Fannie Mae, they usually allow you to include your CapEx. Freddie Mac, SBL, not as typical. Some on case-by-case basis, yes. And bridge loans, of course, most bridge lenders will finance the CapEx, the repair budget. Now, when we move down to prepayment penalties, credit unions by law can't have prepayment penalties. That's why I always look at credit unions as an option as opposed to a bridge loan or Fannie or Freddie, depending on the strategy of the acquisition of the multifamily property. Fannie Mae, usually a yield maintenance, which is very expensive if you pay it off early. Freddie Mac, more often than not, is a step down, which might be a declining 5-year, 5, 4, 3, 2, 1, depending on the term of the loan. And then on bridge loans, they don't normally have any prepayment penalties, but they do have sometimes exit fee, where they might charge you a 1% or a 0.5% exit fee when you pay off or refinance existing property. Borrower experience. Bank, credit union, they're more open to working with newer investors that don't have the multifamily experience versus Fannie and Freddie. That's a requirement that you have multifamily experience. And sometimes even they want to see that you have agency debt experience, that you have, signed for a Freddie Mac loan in the past. Bridge loans, depending on the type of deal it is, they're sometimes okay with a less experienced borrower. This is just kind of a general guideline. I mean, because there's lots of variables and things change, and there's just different circumstances for each loan. I just wanted to simply give you kind of the basic kind of guidelines so you got an overview of that. I should have included HUD, because HUD is another multifamily product, and that is really good for long-term holds. It's a 35-year AM, which means increased cash flow, super low rates, and there's some pros and cons to HUD as well. But I hope you enjoyed this episode. I look forward to seeing you on the next episode. And please subscribe and also share this with your colleagues. Really appreciate you watching, and please provide any feedback to me or comments about things you want to hear about in future episodes. Have a great day. Have a great weekend.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.